Transfer pricing has become one of the UAE's most important corporate tax compliance requirements. Businesses must now show that their intercompany dealings are properly documented, disclosed, and backed by clear evidence. So, why has this become such a critical part of tax compliance in the UAE? Let's start with a simple question. Do you own or manage more than one company under the same group? If those businesses trade with each other in any way, you're already part of what's known as transfer pricing. So what is transfer pricing? Let's understand it in simple terms. Transfer pricing is simply the way prices are set for transactions between entities that are part of the same group. For example, if your parent company sells materials to its subsidiary, or one branch provides support services to another, those prices form part of your transfer pricing framework. Because the parties are related, they could influence each other's pricing, and that's precisely why the tax authority steps in to ensure fairness. The arm's length principle is what assures that fairness. It is the international standard for pricing transactions between related entities worldwide. The arm's length principle suggests you must price your intercompany transactions as if you were dealing with a completely unrelated business. For example, if your UAE parent company provides management services to its subsidiary, the fee charged should be comparable to what an independent consulting firm would charge for similar services under similar conditions. This principle is applied in 3 stages. First, identify and analyze every controlled transaction: goods, services, loans, royalties, mapping the functions performed, assets used, and risks assumed. Second, select the most appropriate transfer pricing method. Commonly applied OECD-recognized methods include comparable uncontrolled price method, cost-plus method, transactional net margin method using cost-based PLI, among others. And then finally, determine the arm's length price based on comparable market data and document how you arrived at it. Pricing your transactions correctly is only half the job. You also have to prove it. The documentation process depends on your business's size and scope, but every taxpayer must be able to show the FTA that its related party dealings are at arm's length. Disclosure thresholds apply for related parties and connected persons. If the aggregate value of transactions with related parties exceeds AED 40 million in a tax period, the taxpayer must complete the related party and connected person disclosure form when filing the corporate tax return. Once this threshold is crossed, each category of related party transactions with a value greater than AED 4 million must be itemized separately. For connected persons, the bar is much lower. If the aggregate value of transactions with any one connected person exceeds AED 500,000 in a tax period, those transactions must also be disclosed. Master file and local file requirements come next. You must prepare these files if your UAE revenue is AED 200 million or more, or if your group's consolidated global revenue exceeds AED 3.15 billion. There is one exception. If your entity belongs to a UAE headquartered group with no foreign operations, you're exempt from the master file requirement, but you must still maintain a local file. So what exactly goes into these files? The master file provides a global blueprint of your group's business, its organizational structure, key profit drivers, and supply chain. It also includes information on group intangibles, financing arrangements, and consolidated financial statements. The local file zooms in on your UAE entity. It includes details about your management structure, intercompany transactions, functional and economic analyses, and financial reconciliations, all showing that your pricing is fair and compliant. For large multinational groups with consolidated revenue exceeding AED 3.15 billion, a country-by-country report is also required. Complying with transfer pricing regulations can indeed be challenging for companies. First, the rules themselves can be complex. Interpreting and applying them correctly, especially when operating across multiple jurisdictions, often poses a real challenge. Second, data collection can be a major hurdle. Gathering complete and accurate information on intercompany transactions, financials, and comparables takes both time and resources. Third, identifying reliable comparables can be difficult, especially in niche industries or regions with limited market data. Then comes the documentation. Preparing the master file, local file, and country-by-country report is a detailed and demanding process. And finally, there's always the risk of disputes. Even when you've done everything right, tax authorities may still question your transfer pricing arrangements. So it's crucial to be fully prepared. At its core, transfer pricing compliance is about fairness and transparency. Getting it right protects you from penalties, adjustments, and lengthy disputes, and strengthens the credibility of your financial reporting. So here's the question to leave you with. If the tax authority examined your intercompany transactions tomorrow, would your pricing and documentation stand up to that scrutiny? That's where we come in. AKW Consultant. We manage transfer pricing compliance end to end. Our team of chartered accountants and corporate tax specialists ensures all controlled transactions meet the arm's length principle, advises on pricing adjustments, and identifies related parties and connected persons through detailed functional and comparability analyses. We apply OECD-recognized methods in line with UAE regulations, prepare and review master and local files, and assist with transfer pricing disclosure forms and country-by-country reports. Beyond compliance, we help develop intra-group pricing policies and benchmarks that stand up to FTA scrutiny and strengthen your overall tax governance framework. Your assurance in tax transparency, AKW Consultants.